Hi everybody and welcome back. My name's Alan Yates and this is the Peregrine Capital Hedge Fund Training Academy. So today we're running through the second module, which is really about how hedge funds differ from some of the more traditional unit trusts that you have invariably utilized in your practice. I'm going to start off just giving you a couple of the similarities and differences, and then we're going to dive into the differences specifically around short selling, things like pair trades, the flexible mandates, and the absolute return focus of these funds. So let's start with the similarities. So where are we similar? I think the most important part to mention is that we are a regulated CIS structure. So hedge funds are regulated in South Africa. We were, in fact, the first market in the world to regulate hedge. And I think that's a huge benefit for investors and for yourselves because you've obviously got that oversight, the governance of the FSCA that applies to all other unit trusts applying to us as well. We also invest in very similar asset classes. So you will see that our asset class makeup is the same as most of the balanced funds out there. It's the equities, it's the bonds, it's the cash, it's the local, and it's the offshore stuff. Investment minimums these days are very similar to what you know and are used to in the long-only space. The funds are daily dealing, they're open to and very much aimed at retail investors as they are retail hedge funds. And I think most importantly, they're now very accessible on all the major list platforms. And it's not our funds only that are accessible on those platforms. Every time I check, I see a good selection of good hedge fund managers out there available on the major lists, and more being added every day. So then let's dive into some of the differences. And I think the main difference is around our ability to generate returns regardless of the direction of the overall market. And I'll cover exactly how we do that in a second. But if you think about a long-only, whether it's a long-only equity fund or a balanced fund, really there's somewhat of a buy and hold investment strategy involved here. So, so if the fund manager likes a company, likes a stock, likes a bond, whatever it might be, they can buy that position into their fund. If there's something that they don't like, if there's a company they think is overvalued or has problems or there's some issues around it, they are able to, at best, not hold that name in their portfolio, or more likely probably just be underweight whatever the index allocation is to that portfolio. To that particular holding. Now, that means that their returns are dependent on the market. Their returns are dependent on the market increasing in value and the underlying investments increasing in value. So there's cognizance of the benchmark. And I think that's the first difference between a hedge fund and a traditional long-only fund, is that we don't have much cognizance of what the benchmark is doing. It's very much an absolute return focus from a hedge fund management perspective. So our investors come to us with mandate to say, we expect you to generate returns for us regardless of what the overall market is doing. And depending on the mandate of the fund in question, that can be more easily or less easily achieved. But nonetheless, it's a case of saying, fill your portfolio with the best investment ideas, not ideas that are cognizant of what's in a benchmark or not in a benchmark. The second part of it is to say that we have very flexible mandates. So traditionally, hedge fund mandates are quite wide. They're not as prescriptive as a lot of the long-only mandates in terms of the assets we can hold and can't hold. And they're less prescriptive, certainly in terms of kind of your allocation bands or your allocation limits. So you are able to be flexible and you are able to be nimble and quick and to change your mind as the facts change. And I think that for us, certainly as Peregrine Capital, is one of the main advantages of being able to run hedge money, is that we are not beholden to a particular kind of structured mandate that says you have to have X allocation to this and Y allocation to that. It means that we can simply populate our portfolios with the best risk-adjusted return investment ideas we can find. Then the two main things, and I think the two things that are most interesting to investors and why they come to us, is to say that we have many ways to protect value of our investors' assets, deliver returns, and protect on that downside. And I'll run through a couple of the ways we do that in a second. But then the second portion of that is to say that because of that bi-directional investment strategy, the ability to short, the ability to hedge, it means that we are not beholden to a rising market in order to generate our returns. We can generate returns in a market that is potentially going sideways, a market that is falling. We are able to populate that portfolio with ideas that don't just require that rising market. So let's get into some of the detail here. So the first one, and I think the big differentiator between a traditional long-only fund and a hedge fund is obviously our ability to short sell. And if I can give you short selling as a pretty simple example, it's a potentially a complicated concept, but actually it's pretty straightforward if you break it down. Short selling is where we buy something we sell something we don't own in order to profit from the fall in the price of that asset. So if I use my basic example here, I borrow an apple from you and I sell that apple at market price, and let's say market price is 10 Rand on the day. I'm obviously hoping and I'm of the belief that the price of apples is going to fall. And should the price of apples fall and my investment thesis plays out, I can go back to the market, I can buy an apple for 5 Rand, pocket the 5 Rand profit and return the apple that I have borrowed from you to you, and I walk away with 5 Rands of profit. And that's really the kind of the way short selling works. Now, whether you're short selling an index, you're short selling an individual stock, essentially the same mechanism applies. We borrow those securities from someone who is a current holder of those securities. We sell them into the market. We wait for the price to fall. We buy it back, and we profit from that viewpoint. Now, for us, particularly as Peregrine Capital, we tend to make use of the short selling ability mainly in what we call pair trades. And the reason we do this is twofold. Number one is to say that it allows us to take advantage of valuation discrepancies that emerge within sectors or industries. And so really what we're trying to do is we're trying to do our work and say, we think, let's use the example here, we think retailer number one is going to outperform retailer number two because they're executing better, their cost management's better, their management team's better, whatever the driver might be. We want to take that view, but we don't necessarily want to take a view on the retail sector as a whole. So we don't want to add market exposure to our portfolio. We want to play a relative winner and loser against one another. So what do? We purchase, let's say, 100 Rand in retailer number two. We short sell 100 Rand in retailer number one. So what that means is that we have no actual exposure at the start of this trade to the overall market, so there's no beta in this transaction, and we have no overall exposure to the retail sector because there is no exposure to retail generally in this transaction. And then we are hoping for retailer number two to deliver on that outperformance, that execution, whatever it might be. And the appeal of that is really twofold. It means that you can generate a return regardless of what direction that sector or indeed that entire market is going in. So even if in a tough economy, if the market's been stagnant, the market's struggling, retail is struggling, even if both of those retailers drop in price, we are looking for the differential between the two to be positive. So if our view is correct, we can make that performance profit from that position, regardless of what the overall market does and regardless of what the retail sector does. And that is a very powerful tool to generate returns in the portfolio without taking market exposure, so without adding beta to the portfolio, and the ability to generate returns regardless of what the overall market direction is looking like. The second element that I think is a benefit of hedge funds and how we are able to differentiate ourselves from the long-only environment is our ability to protect on the downside. So now what I've got for you here on this rather busy chart is simply every down month on the JSE since the inception of our pure hedge fund in 1998. And I think what's striking about this is it shows you that on average, when the market falls, it falls quite significantly. 3.5% is the average monthly fall on the JSE when it is negative. And if you compare that to our pure hedge fund, you can see we've generated quite significant positive returns over that period on average in those months. And that, I think, adds something very different to an investor's return profile, because it means that even if the rest of their portfolio is exposed to the market and is doing somewhat poorly in any given period, the addition of a hedge fund, or certainly the addition of our hedge funds, but I do believe this applies to many hedge fund managers, is their ability to generate that uncorrelated return profile for you. Next thing that is obviously quite different is the flexible mandates. So I think for us, particularly as a specialist hedge fund manager, so we don't manage long-only money, we only manage hedge. What is the appeal of a hedge fund as a vehicle for money management to us? It is this flexibility. It means that we are able to maximize returns, we are able to manage risk, and we have the flexibility to do that quickly and efficiently within those portfolios. So we can capitalize on market discrepancies. We can change our minds very quickly when the facts change. And I think that's a very important part of how we've been able to protect on that downside over time. And it also allows us to take advantage of certain special situations that exist in markets that a long-only manager might not be able to take advantage of. So to give you an example of that, if you think back a couple of years, OUTsurance was not, in fact, a listed business. So OUTsurance was a business that was owned by RMI, and RMI was the listed entity. But RMI as a listed entity was made up of really three things. So it was OUTsurance, Momentum Metropolitan, and Discovery. So if you were a long-only manager and you wanted exposure to OUTsurance, you had to buy essentially this basket, this ready listed basket of names. So it was, you had exposure to Discovery, you had this exposure to MMI, and you had exposure to OUTsurance. Now, we identified OUTsurance as an exceptional business, and we wanted exposure to them, but we didn't want exposure to those other two businesses at the time. Now, the appeal of this flexible mandate meant that we could go and buy that RMI holding, but then we could hedge out, we could essentially short out the MMI exposure, and we could short out the Discovery exposure, so that all we had was exposure to that rump. What we call a rump trade, the rump of OUTsurance. And obviously that was a really profitable position for us, and it's been a fantastic position for us, and therefore, and a company we've held since the unbundling of OUTsurance from RMI a number of years ago. But it just gives you that flexibility. It gives you the ability to find those situations where you can unlock value for investors that are not available to you if you are running a long-only mandate. And at the end of the day, what are we trying to achieve? I think the answer is it is about risk-adjusted returns for our investors. So a hedge fund with this additional toolkit, and I think with this additional toolkit, it must be said, comes additional responsibility of the manager. The manager needs to know how to use this toolkit effectively, efficiently, and prudently. And for us, that means that we want to manage risk in our portfolios. Our investors don't come to us saying, I'm very happy for you to just swing for the fences and shoot the lights out. And 1 year you might be up 30%, and the next year you might be down 30%, but I'm along for the ride. That certainly isn't our model. And I mean, there certainly are hedge fund managers and very good hedge fund managers who are happy to utilize that toolkit to generate what they're hoping is exceptional outperformance over periods. But obviously with that comes significant amounts of increase in volatility and risk. That's not our model. Our model is really just to say, can we deliver the best possible risk-adjusted return in those risk buckets that we're comfortable playing in? And I think this graph shows you that we have been pretty good at doing that over that period of time. So the flexibility in that mandate, the ability to protect on the downside, the ability to not be cognizant of a benchmark, and only populate your portfolio with the best investment ideas has certainly served us well over the past 26 years, but in this graph it's over the past 15 years. The last thing to say is obviously that absolute return focus, and I think this is certainly something that where hedge funds are different to the long-only fund managers out there. If you're a long-only manager, you are measured relative to a benchmark. So if you're an equity fund, you're obviously measured relative to an equity index. If you're a balanced fund, you will be measured relative to your CISA category or perhaps a 60-40 blend of a couple of indices. But nonetheless, you therefore have to be benchmark cognizant. So what you're trying to do as a long-only manager is you're trying to outperform that benchmark. So you want to make sure that if the benchmark is up 5, you're up more than that. But likewise, you'd be comfortable that if the benchmark is down 10 and you're down 8, then you've actually done a pretty good job relative to the benchmark as the long-only manager in question. Now, for a hedge fund manager, that's not the case. We're not benchmark cognizant, we're benchmark agnostic. And what that means is we're focusing on absolute returns. So we want to make sure that we can generate positive returns for an investor regardless of what the market is doing. And that's what investors come to us for. They come to us. So truthfully, if I went to any of our investors and said, listen, market was down 30, we're down 25, we think we've done a pretty good job, I'd have some very grumpy investors on our hands because they are looking for that absolute return focus. And then the last thing that I think results from all of these things together is a diversification advantage. And really what that means is that because we populate our portfolios very differently to the overall index, because we populate our portfolios with this bi-directional investment strategy and these special situation, or whatever you want to call them, different pockets of alpha generation, it means that we have a very different return stream profile to most of the other fund managers you would be used to in the long-only space. So what I've got for you here is the 5-year correlation of every general equity fund, multi-equity high and multi-equity low balanced funds over the last 5 years, and the correlation to the JSE Cap Swix. And what struck me about this graph in particular was that in any of those categories, including the kind of low equity balanced funds, you've got kind of a 75% correlation between the performance of the market and the performance of those funds. So that means that the vast majority of the opportunities available to you as a financial advisor putting together a portfolio are actually pretty highly correlated to the overall market and therefore pretty highly correlated to each other. Now, if you compare that to our pure hedge fund and high growth fund, and I'm plotting our funds here because obviously that's the data I've got, but I would suggest that if you were to look at other hedge fund managers, you might get a pretty similar picture coming out, is that our correlation is significantly lower. Now, for those that are unaware, our high growth fund is a fund where we are happy to take more equity content, so we do run relatively high equity content in that fund, and therefore the correlation is somewhat higher. But I mean, if you look at it, it's still less than 50%, which is still less than the vast majority of the other options available to you by quite some way. And then our pure hedge fund, which is our market neutral fund, is bang on zero. It has zero correlation to the overall index, and that adds value to an investor portfolio. Well, certainly I think it does, because it is able to generate that return stream irrespective of what the market is doing. It's not dependent on the market and not dependent on market variables to generate the return that your investor is looking for. So, in summary, how is a hedge fund different from a traditional unit trust? Well, I mean, I think the first thing is obviously that short selling and pair trade element. When we use that to reduce the volatility, we use that to limit those negative returns and protect on the downside. The second element we've mentioned is obviously the flexible mandate. So we've got that wider range of investment tools, investment toolkit, so to speak, and we're using that to make sure that we're able to maximize return, minimize risks, generate that best risk-adjusted return we can. And then the last one is obviously the ability to be benchmark agnostic, generate those absolute returns, focus on generating returns for our investors regardless of what the market is doing around us. And that's the end of this one. Thanks for joining me. See you next time.